Hey, what's up traders? Welcome back to the channel. And today we're breaking down one of the most crucial concepts in futures trading, ticks and points. If you've ever looked at a futures chart and wonder how price movement translates into dollars, then this video is for you. We're going to cover what ticks and points are, how they work in futures markets, and how to calculate profit and loss using ticks and points. So if you're ready to level up your futures trading knowledge, hit that like button and let's jump right in. Now, before we get started, this video is for educational purposes only. I am not a financial advisor, and you should definitely trade at your own risk. All right, now let's start with the basics. In futures trading, price moves in increments, and those increments are measured in ticks and points. But what's the difference? A point is a full movement of a futures contract. A tick is the smallest movement allowed by that contract. Think of it like this. A point is a larger unit of measurement, while a tick is a fraction of the movement. Almost like feet and inches. Now, not all futures contracts are the same. Different markets have different tick sizes and point values. Let's look at some examples. The E-mini S&P 500, or ES, tick size is 0.25. The tick value is $12.50 per contract. One full point is 4 ticks. So 0.25 times 4 would equal $50. So one full point movement on the ES is equal to $50. Now on crude oil futures, or CL, the tick size is 0.01. The tick value is $10 per contract, and one full point equals 100 ticks. So 0.01 times 100 would equal $1,000. So one full point movement of crude oil is equal to $1,000. Now gold futures, or GC, the tick size is 0.1. The tick value is $10 per contract. One full point equals 10 ticks. So 0.1 times 10 would equal $100. So one full point movement of gold equals $100. Now as you can see, the tick size and tick value vary between contracts. Now knowing this is crucial because it helps you calculate your potential profits and losses. Now how do you calculate this? Let's say you're trading the E-mini S&P 500, or ES, and you're going long, or buying, at $4,000. Then price moves up to $4,002. How much have you made? Now $4,002 from $4,000 is 2 full points. Each point is $50 per contract. 2 points times $50 is $100 in profit. Now what if price moved against you 3 points? Well, that would be a $150 loss. This is why understanding ticks and point values is so important. But why do ticks and points matter for risk management? If you don't understand tick values, you could risk way more than you intend to. That's why every professional knows the tick value of the contracts that they trade. The tick value for gold is different than the tick value for crude oil. So knowing this is very important, because if you go into it thinking they all translate the same, you could lose a lot more money than you intend to. Now here's some pro tips. Always make sure you check the tick value of a contract before trading. Always use stop losses and make sure to base them off of ticks to control risk. All right, traders, now that you know exactly what ticks and points are, how they work, and why they're important in futures trading, if you found this video helpful, make sure to smash that like button and subscribe for more trading content. And drop a comment down below. What futures contract do you trade the most? Let's talk about it.